All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. A lot going on out there here this morning, and a lot of action out there in the market. And it kicked off yesterday with the Fed, and we have the Fed from this kind of overbought position in the market. And Fed comes out, and they basically go ultra dovish. I mean, we talked about it yesterday. They went beyond market expectations in terms of dovishness. They took all rate hikes off the table this year, and they basically said, "Hey, the numbers are looking worse. The risks are on the rise, and so we are going to stop our easing or our process here of essentially making things a little more normal." And so we have the Fed just really come out with a very dovish stance. It's been interesting to listen to some of the analysts, some of the commentary on it. Some of it gets quite political. There's a very interesting political argument when it comes down to it. But it is one where it is what it is, and it's one where there's a lot of different opinions on it out there. I shared with you mine yesterday. I think this is a pretty good sign that things are a lot worse out there than or going to get a lot worse out there than what the market is priced in or what the market is expecting. But obviously, things can change and evolve. In fact, some of the economic data here today is a little bit better than expected. Jobless claims, the Philly Fed Index, a little bit better than expected. So that is, that's helping to kind of My apologies for not grabbing that mute button on time there. Again, my apologies there. But anyway, market here is kind of dealing with all these things. Now you can see S&P futures rallied here after the bell yesterday. We saw futures come all the way back down magically, to right where they were before the Fed. It's just like magic happens every time, almost every time. And and then futures start to rally, and they rally on Micron earnings. And we saw Micron earnings, and I haven't gone through everything here with it just yet. But you can see Micron, tracking on higher after their earnings. A little bit. About $2, about 5%, and that helped to lift futures just a little bit. But once we started to see Japan open up, China open up, futures, they just continued to drift on lower. And then we saw this kind of shot lower right here, about 10 points lower on the ECB and European Central Bank comments. And then there's a little bit of stabilization as we've seen some U.S. economic data. So, really kind of wrestling around the lows from yesterday, the kind of Trump lows from yesterday. But I don't look at any of these levels and think, wow, this is an important level. This is a key level. This level right here, this means something, or that level means something. We don't see the volumes or the flows, suggest anything of that nature. It is one where, if you look at it from an hour standpoint right here, you can see each of these lows, this week are getting just a little bit lower, right? The highs getting just a little bit lower. But to say, wow, this level right here or this level right here, I just don't think we can say that. I'd be very surprised if we don't see 2,800 revisited, and I'd be very surprised if we don't see 2,780 revisited, at least here, in the short term, and see kind of a normalized retracement of, the kind of runaway rally from last week. So that's kind of where the market is kind of set up at here this morning. Small caps, they're going to gap down, but not a whole lot. We're not talking about this monster gap here this morning. I know for some it feels like that because wow, the market's actually gapping down, so it feels really bearish. But S&P only set to gap down about 8 points. Small caps, the IWM set to gap down about 50 cents. So we're not talking about these monster gaps here, taking place in the market. The Q's down about 50 cents. So a very shallow gap here this morning, here in the S&P. And, like I mentioned yesterday, I think the first hour here this morning is still part of the Fed reaction from yesterday. And, it's about after this first hour that I'll be a lot more interested in looking at where some of the setups are and, where some of the price action is to take advantage of there for the challenge. We also have gold, which ripped higher here on the Fed. It is holding its gains. It is not reversed like S&P futures. We also have bonds, which pushed higher after the Fed. They are holding their gains, unlike S&P futures. So we talked about the validity of reaction in gold and bonds yesterday based on what the Fed said. And those valid type reactions have held. This kind of stock market euphoria over, hey, Fed's not going to raise rates in a market environment that's actually getting worse. That has been erased, fairly quickly here overall. I do want to point out, if you go out and, we could just go to something like a MarketWatch.com. And you can do this at any on any site out there. Let's see here if the computer will grab it here. All right. But here we go. Most accurate recession indicator is closer to flashing red as the Fed's dovish double down. Okay. Guggenheim, not a bad time to take some profits on this post-2009 stock market rally. Okay. But basically, what do you have? You have some big funds, some big analysts, putting some of the logic together and saying, look, this isn't 1 + 2 equals, continued bull market. And there are some actual risks out there and some serious risks out there overall. And, we're starting to see it in the news. Or in some of the headlines and in some of the commentaries that are out there. And, where I stand after yesterday with all of that. But anyway, I want to pull a chart over here for you that I'll leave you with here this morning. This is 2010. And, I was back fund managing, and, we had the flash crash. We had a summer where Greek debt, European debt starts to come into the equation. We get this kind of head and shoulders bottom, right? We get this breakout, and, here we go to new highs. We get close to new highs, and then market's pretty overbought. Market's been struggling to track higher. It's pretty overbought. And then from this kind of overbought position, the market goes up basically 2% in a matter of 24 hours. Now, 2% on the market today, right? 2% on the S&P today is what? Is about 56 to 60 points, right? So this is about a 56-point move higher, to put that in perspective. What happened here? Well, this is the Fed. This is the Fed coming out and basically adding another level of quantitative easing here to the markets. And they did it because they were seeing the market data erode. Their numbers erode. Market had gone through a rough spell, had recovered most of it. They kind of went more dovish, and almost more dovish than people thought they could go. The market got a huge bounce, only to erase it, relatively quickly. But that's not the end of the story. The Fed's action and quantitative easing helped to really push this market higher. But there's a big difference between what happened yesterday and what happened back here. The Fed was taking action back here. The Fed was doing things to help prop things up. They didn't just announce inaction. And yesterday we saw the Fed say, hey, we're going to stop doing things. Yeah, they're still going to unwind some of the balance sheet out to September and stuff like that, but no new action. Here was announced new action, more dovish. Today was announced, hey, we're not gonna react. We're not gonna move. We're not gonna act. And I think the risk of having a different style play out, two things is significantly greater. Here, I'm not saying that we're gonna see we're gonna see things play out the way they did back here in November 2010. But, as I looked and as I kind of went through things, last night, I just couldn't help but be reminded of this period and, just some of the similarities. Just some of the similarities that are out there. And, ultimately, we'll see where some of the trade war cards, land and where some of the economic data lands and, most importantly, where some of the earnings land. And that will definitely be, the driver. But I think it's one of those where we could argue that recession risk in the global economy is higher today than at any time since the summer of 2010. There was recession risk, high recession risk. A recession did not materialize. Just because there's recession risk doesn't mean a recession materializes. But it is one where it's significantly greater risk today than what it has been in quite some time. In this market. I'm going to watch the open here this morning, kind of take a look at where things are, how things move around. I'm not looking to make a trade right on the open. I do want to let the first hour play out, and then I'll jump on video. I'll talk about some of the setups that are out there, some of the things that I'm seeing, some of the things that I'm looking at. If there's a good setup right then, I'll go ahead and jump into it, and we'll jump on video. About Give me about 60 to 90 minutes here after the market opens, and we'll talk to you then. Have yourselves a great one, and we'll talk to you later. Take care.